Hello.
Hi, everybody.
Hi.
Is it just panelists or everybody's on? Hi, guys.
Hey, Zafran. Good to see you.
How are
Hello.
you? Hi, Marco. Hi, Sam. Hi, Robert. Hi, Paul.
Hi.
Hello, everybody.
Pleasure meeting all you guys and seeing you all again. So we will let in the session of the Incopa initiative by JCC. This one will have to do with investments, and the title of which is Investors at Work. We'll be looking at the lay of the land in the continent, more specifically in Ethiopia, in terms of investments and where we are with regards to additional interest, the deployment of capital currently, both risk and TA. Before that, so I would like to welcome everybody. We have our panelists, which is Samuel is from IFC. We have Marco from LFS Advisory, Robert from FMO, and Paul from Renew. I will let them briefly state what their current activities or planned activities are in Africa, and more specifically in Ethiopia. But before that, we would like to thank our host, which is one of the up and coming co-working spaces in Ethiopia. And I would like her to introduce her co-working space, Adora, based Central Addis next to the EU. So we'd like to thank her for hosting this session, and give her let her say a few words on before we start.
Hi, everyone. It's a pleasure to host this panel, really. This is a new startup. It's centrally located, like you said, across the street from the EU offices next to the Saling Hotel in Bole Atlas. Adore is going to be a co-working and a hotel. Also, it has dining options. We will have 42 hotel rooms, 16 extended stay rooms with kitchens. We will also have 120 shared co-working spaces, along with private offices and meeting rooms. So it's very catered towards the digital nomad, really. So thank you and welcome.
Thank you. She forgot to add that there is actually a hotel also in combination with the working space. So yeah, so let us start. So thank you everybody for your attendance, and we will go ahead in terms of with the questions and the actual discussions that we have. First question, let me direct it to I guess Paul and then we'll let others pitch in also. It's really about the current trend of seeing quite a plurality of deals in Africa, and notionals are growing also. If we look at what's going on in Nigeria with Flutterwave and a few other deals, and we started to see a few more in Kenya and a few other places. So, my question really is Africa the new focus, or what dynamics have changed for such an acceleration in terms of investments and also the notionals, which are increasing?
Thank you. Yeah, so thank you very much for having me. My name is Paul Reynolds.
I'm a managing partner at Renew, and I run our asset management business. We are currently operating in Ethiopia, Uganda, and Rwanda, but we have an expectation of being in 20 countries by 2040. So we are firmly of the belief that Africa is the right focus, certainly for us. And I think the opportunity is clear when it comes to the availability of opportunities from all the way from commodities up to services, the immaturity of markets, the penetration of technology and services, the innovation, the sheer size of the talent, the caliber of the talent that's available on the continent means that the opportunity for Africa to actually become a sort of genuine value-added exporter to the rest of the world in both goods and services is very clear. There's a lot of challenges in the meantime, and those present opportunities as well, because those challenges need to be solved, and it takes money, it takes innovation, and a lot of hard work from people with experience. So, yeah, I think certainly from our perspective, we're all heavily invested into the investment opportunity in Africa.
Excellent. Marco, do you have anything to add to that?
No, I very much agree with Paul. I think the figures are out there; they speak for themselves. Yeah, certainly there's been both the demographics and the GDP growth rates, but I think even more to the point of today, the flows, right, in PE and VC over the past years have been very encouraging. And yeah, I think the slump of the first part of last year seems to have been quickly overcome. So we very much share the bullish view and the optimism that Paul just articulated.
Excellent. Listen, I'm just going to go through the other panelists so that it gives them an occasion also to briefly discuss in terms of what their activities are on the continent, and especially in East Africa and Ethiopia. So Samuel, why don't you can further address this question, but also use it in terms of briefly letting us know of your IFC's activities in the region.
Thank you, Samson, and it's a pleasure to be here on this panel. IFC is the private sector arm of the World Bank Group, and we do investments in all sectors. We do almost all types of instruments, debt, equity, and other forms of instruments into primarily emerging markets. So basically everything and a lot in Africa. We're spread across the continent. We do a lot of stuff in Asia. So basically we're doing everything that is not in any of the, let's just call them the bigger countries or bigger economies. We're structured in 4 key departments: infrastructure, manufacturing, agribusiness, and social services. We have our financial institutions group, and then we have our disruptive technologies and funds group, which is where I sit in the private equity space. So in the private equity space in Africa, we invest in growth funds. We co-invest with other LPs like Robert from FMO. We've done quite a few investments with them into funds. We also have another section of funds which is focused on SMEs. I sit in that particular unit, and I lead investment advisory in that particular unit. We currently, coming down to Ethiopia, we currently have 2 funds that were invested in Ethiopia, but I also lead advisory activity related to the enabling environment. So there are 2 projects that I've recently done in Ethiopia. One is to look at the regulatory environment for private equity and venture capital vehicles, and the other is to look at startup catalyst, startups and entrepreneurship in Ethiopia, look to see what the current situation is in Ethiopia, and see how we can support with advisory to take this forward. Now, in terms of the specific question of the increase in deals that are coming across in Africa, I won't go so far to say as Africa is where you're going to find all the richest pickings across the globe, but I will say that the demographics in Africa and the increasing demand for quality of goods and services is beginning to reflect in the kinds of deals that are available on the continent. So we find that whether it be our direct investments through our other departments or indirect investment through funds, many more interesting deals are coming through In particular, our venture capital team is also seeing some very interesting stuff, tech-enabled stuff that is coming through. And IFC continues to invest in these either directly or indirectly and continue to provide advisory support in that field. So we're encouraged by what we see. We know there's a lot more work to be done, but we're committed to emerging markets, and we'll continue to do what we do in Africa and across other countries like Ethiopia. Thank you.
Thank you, Sam. Robert, do you want to bounce off that and briefly tell us in terms of where you guys are involved in Africa and your specific activities? I know you're in the exploration stage, at least in Ethiopia.
Well, yes, and that would be with the Ventures program in particular. So hi again, Robert Haney, thanks for having me. I am working and dedicated to the Ventures program within FMO, which is the portion of FMO focused on the VC kind of industry, if you will. Ventures program is a new-ish program launched last year with additional EC backing. So it's a 200 million euro investment vehicle. And working alongside of that is a technical assistance facility, of which I'm focused and leading the ecosystem building activity under this technical assistance facility, or TAF. And as Samson, you just said, the past several months, 6 to 7 months, we have been really narrowing down on what we're going to do around ecosystem building under this facility. And have been exploring a few markets in particular, because kind of took a two-pronged approach to think cross-cuttingly, what do early stage ventures need in this space? But then we need to look specifically in certain geographies to get down to where issues can be very hyper-local for small and growing ventures. So Ethiopia has been one of those countries we're looking at. I think it's gonna probably shape up to be a bit more of our midterm engagement strategy, while we look to perhaps start some activities later this year, but continue to figure out if and how can we support the promising activity that we're seeing in Ethiopia. So, you know, it's good to kind of take part in this conversation. And what I might add to that is not only are we seeing the potential with Ethiopia, but across the continent. And that's really to say, while the Ventures program has a bit more of a global remit with Asia, South Asia included, under our ecosystem building program, we're starting with Africa, or specifically sub-Saharan Africa, and then the MENA region. You know, on the continent alone, I think there's been recent data from Partech and Africa Arena, you know, citing how even though there was a contraction in 2020 on equity deals, there was an increase in the number of VC deals. So I think, you know, that alludes to what Samuel was just saying. I think we're starting to see an increase for demand in goods and services and talent and innovation. So yeah, that's one of the key markets for the Ventures program. And we're excited to continue to assess how we can be helpful in this development.
Excellent, thank you, Robert. I'm just going to give Marco a quick chance also to let us know in terms of the activities of LFS Advisory, and then we can move on to the meat of the subject.
Thank you. Yeah, so I'm Marco. I work at LFS Advisory here in Berlin. It's an impact finance advisory firm. We've been around for 25 years, I would say now. Certainly Africa is our premier region. And yes, we work together until very recently with Samson on an interesting project in Ethiopia, precisely on the structuring of the entrepreneurship fund of Ethiopia. So I think that gave us a very interesting vantage point, yes, to assess a lot of the things that are promising developments that are going on in the country now. So I'll be happy to talk about it.
Great, thank you. Just quickly, as your host, Sway Ventures is a global investment company as well as trading. Most of our assets are proprietary with 2 large private high net worth families. So we have assets of over $100 million. Mainly Sway and 2 other families, which we invest across Africa and East Asia also, along with trading and advisory. So as Marco said, we are in the process of structuring a fund which would look at startups across their life cycle in terms of maturity in Ethiopia, with an exposure of 30–40% across East Africa. So I guess we're all in the game, and it's interesting to have a meeting at the mines here. Just in terms of following up on the first question, you know, in terms of where we've seen some of these large investments in Africa, it really has been focused on one or two regions, and especially it's been focused on one particular sector, which is the fintech sector, right? At least the large, sexy deals that we've seen. And if not, please let us know. I see Paul sort of shaking his head, so I'll let you start on that, and then we can go across the group. Hey, you're on mute, Paul.
Sorry, Samson, what was the exact question?
It was what the exact question was. You know, the focus has been on fintech, mainly on large deals that we've seen in Nigeria and Kenya and so forth. And also, you know, regionally, at least, the large, sexy deals have been in one or two countries. Yeah. So do you see a more of a pluralization of both the sector and the region as we go forward in the next few years or next year or so forth?
Yes, and I agree with you from one perspective. I mean, what Renew does, you know, we look at small and medium-sized enterprises. We invest equity or debt, depending on the jurisdiction and the structure of the deal, into SMEs. So companies with turnover from 100,000 to 3 million in that sort of order. We're sector agnostic. So we're not an early stage investor. We're not sort of necessarily VC adjacent. And when we look at the outlook for the economies into which we want to be investing and where we want to be developing capacity and ecosystems at the sort of our end of the journey, obviously, there are some major investments, major projects going on in infrastructure, transport and logistics across the continent in the sort of at the other end of the scale. And Samson and his colleagues, putting a lot of money to work in creating the enabling environment for the rest of us to operate efficiently and quickly and reduce demurrage charges and all those good things. But yeah, I think as far as sort of the early stage goes, I agree. I mean, there are a couple of big economies which are mature in terms of their sort of investment climate and business climate. They're experienced in terms of starting, building, ideation, incubation, acceleration. This process has been going for a while. Big, liquid, reasonably wealthy economies where obviously the targets have been coming for a while, and where we always imagined the unicorns would come from. And I think the question for us is, how do we encourage other jurisdictions to get up the curve as fast as possible?
Great. I think Samuel, you had a few points on that also from our previous discussions. Let me know if you want to add on to that.
So yeah, something like, look, I think there's continuing to be interesting deals in the tech sector, but there's also the basic bread and butter deals that are out there. And those bread and butter deals are squeezed, and they're squeezed mostly because of the fact that making bread has become a very basic thing to do. And so if a business wants to start making bread today, really, you're going to be competing with everybody and their cousin who's also baking bread in the area. And some of them are very localized and small units. So therefore, businesses have to look to come with deals that make a change in the economy. I think what COVID has done for everybody last year was to look towards e-commerce, and whether that e-commerce was powered by a fintech or powered by, and I think everything is run into fintech, but by a mobile phone or whatever it was, that was where you found that a lot of businesses were moving to. You also found that certain opportunities came up because of supply chain disruptions, that local entrepreneurs were emboldened to do much more to serve the interests of people. And those all became interesting deals, either integrating into other investments that have already happened in the VC and PE space, but creating general an ecosystem that makes opportunities come out for people to feed us deals into the PMVC sector, but also to begin to serve the needs of people. So several interesting things are happening. I don't think it will be centered around Kenya and Nigeria only. I think in other parts of West Africa, East Africa, Southern Africa, you continue to see a lot of things coming up. We're seeing a lot of, for instance, in heavy manufacturing, we're seeing a lot of car assembly plants coming up in different parts of the world, Rwanda, Ghana, and so on. And these are going to be very interesting things that will require not your typical type of available commercial capital, or require some kind of P and VC type of money to be able to go in there, plus the hand-holding needed to make those businesses thrive. I'll stop there and maybe.
I fully agree, Samuel. I was specifically talking about deal flows rather than the evolution of different sectors when I mentioned Nigeria and Kenya. But in terms of the evolution of actual different sectors and what's popping up because of current situation in the world, I fully agreed. I think Marco had a couple of points on this.
Yeah, no, just to echo, I think also what someone was saying. I recently read an interesting report. I think it was saying that, broadly speaking, yeah, the fintech accounted for 25-30% of VC deals. But that health tech, right, and healthcare in general had been on the rise, right? And I think the author was making some other reasoning, perhaps, of course, this is due to the pandemic, but also this is due to, shifted focus, right, in light of last year. So I think it's interesting. There was a reasoning about the fact that, in many African countries, it's kind of a focus on, for lack of a better word, sort of essential / primary services that somehow have been more resilient, if you want, during the slump of the past year. So I would be personally interested to see if health tech and healthcare continue in 2021.
Yeah, Robert.
Yeah, I want to jump in and put a plug in for ag tech and energy as well, but only because also recent data show that there were some recent deals in ag, and I think we as the ventures program do see that as a promising area, and obviously a lot of opportunity in terms of how do you support small and growing ventures that focus on ag. So we as the ventures program do focus on ag tech and energy and fintech, and also supporting funds. But then I just want to circle back to Samuel's point in terms of e-commerce and bring it back to what we are looking at through our ecosystem building lens, and how we've kind of tried to broaden this focus on tech enabled, as we're calling it, because I think what we're starting to see is even these, let's say, more like livelihood or bread and butter businesses, even those have started to and realize the importance of how do you embrace technology and pivot and continue to evolve. And I think, we're really looking at how do you support ecosystem growth in that way. So I think there, are opportunities beyond just let's say that pure play fintech or the SaaS models that are getting a lot of the attention, but there's definitely other opportunity.
Excellent. Thank you. Moving on, on the same topic, in terms of, obviously, we'll get to Ethiopia specifically with all its idiosyncrasies, but generally speaking, what are some of the restraints or obstacles that you see for PEs and especially VCs in terms of deploying capital within the continent? Robert, do you want to start on this one?
Yeah, sure. I think I'll try to boil it down to maybe 2 points. And I would say that and they're related, would involve some kind of the angel investors and earlier stage investors that are needed to support and then connect with the follow-on investment, and then really the exit potential and exit strategy of that entire range. I think we're seeing challenges to see exits in many of these markets around the VC area, and that's for a variety of reasons, whether it's regulatory, but also the fact that we're not seeing as many kind of promising deals rise up that have that earlier stage connection to angels. And so it's a little bit of, okay, well, we need more angel and local investors, but then we also need to provide that opportunity for them to exit by bringing kind of the VC community to that market and connecting them so that you see that kind of cycle play out.
Interesting. Paul, do you have any thoughts on that? I know you guys are active in Ethiopia also, so it's definitely.
Yeah, I mean, I don't know if now is the right time to start talking about the distinctions in Ethiopia, but there's at a general level.
We're going to get into it a little later.
At a general level.
At a general level.
Yeah, at a general level, obviously, the institutional capital needs to see, has an expectation of growth and return. Obviously, it has an approach to that across its portfolio, but you only crystallize return when you exit. So the absence of secondary and exit opportunities, as Robert alluded to, is probably the biggest disincentive for the off-takers from the angel networks who start these businesses in the first place. I mean, the other sort of challenge, I guess, is to some extent around sort of human resource and the extent to which the operational capacity is developed. Obviously, there are some huge exceptions to that, but in the markets where we operate, it's still a reasonably significant challenge. Getting a business up and off the ground is a function of the village, as people say, and whilst the entrepreneurs have the energy and often the ambition, the ecosystem is just not as advanced as we'd like it to be to support them through the incubation stage into acceleration.
Thanks. Samuel or Marco, anything to add on to that?
Yeah, so I'll add a little bit on that. I think I'll put it in two buckets, and one is the things that a GP or a fund doesn't really have control of, which is really around the regulatory environment, and the regulatory environment to the extent that it may not be restrictive, but to the extent that it is unclear alone, is a difficult presents a hurdle for investments to go in, whether it's from an international DFI or, as Paul has said, also finding local investors who are willing to begin the play in terms of investments into the market. So regulatory environment is a very key thing, both for international players and local players. And then, of course, you also have the sub-commercial players in the market. So you might have quite a few, let's call them public-spirited interventions. You might find a lot of NGO interventions as well. And some of them can be, basically, they're not going to be there forever in the first place. And then they can create a certain mindset in the market that makes it difficult for you to come up with pure commercial capital that can take them forward. And then, of course, capital controls. In some countries, it's difficult to bring in money, and it's not only in the African continent. We've seen this in some countries in Asia. It's difficult to bring in cash as a foreign direct investor, and it's difficult then also to take it out as a foreign direct investor. So those are some of the things on the non-GP side. On the GP side, I think it's been said, finding GPs with the right track record and the right partnership coming together well to be able to do deals, showing that they can do it, they understand it, they've done it before, whether in a private club or otherwise, is very key. Deals require a lot of due diligence, and the supporting environment for due diligence may not exist. Can you rely on financial statements? Can you rely on local service providers? These are things that also, and then of course the whole area of exits. And I think quite a few of us have mentioned it. The typical thing, somebody promises you IPOs, are those going to happen? Realistically, maybe not. So I think these are all things that become major issues to making it difficult for the PVC space to grow in some places. Other than that, I'll also add a few things on investment strategy. Again, as has been said, Renew is very clear on what they invest in. IFC is also very clear. FMO, maybe through the ventures program, is also very clear on what they invest in. So if Renew says they're going to do 100K to 3 million, and in the market you're finding people looking to do $10 million tickets or $50,000 tickets, then that is not going to make the industry grow, right? You're going to find a mismatch between what is being set up as vehicles versus what investors want to look at. So I think those are all areas that basically can make it difficult for the PVC space to grow in many countries. And this is not peculiar to Africa only. As I said, we've seen this in South Asia and other countries as well. Thanks.
Great.
Pick up on that?
Sure,
Marco,
go ahead.
let me defer to Marco, allow you to go first.
Oh, no, I mean, I'm a bit biased because I'm an FX guy by trade. And I was about to say that capital controls and foreign exchange, especially for Ethiopia, still discourage quite a share of investors. But I think the good news is that reforms have been made, right, and are being made, and I think that there's reason to be slightly more optimistic than 5 years ago about the overall ability to invest and repatriate with a moderate level of hassle. Yeah. It's not going to be exactly pain-free, but certainly it looks a bit better, yeah, from what we researched recently, at least. Yeah.
Absolutely. Robert?
Yeah, so I just wanted to say, and to elaborate on that point around GPs and what do we need to see from GPs, and really getting to this missing middle that a lot of people are talking about, right? Which is this earlier stage or this gap in deals that, you know, are perhaps between that, you know, 20,000 up to 2 million mark. And that area really needs kind of a different approach. And so I think what we need are GPs that are innovating and are blending capital and being creative and are frankly more local or women and minority. And so that's one area that we're focused on is, and a lot of people are starting to look at this idea of first-time fund managers, perhaps as a common name, but it's really about emerging capital allocators writ large that are more locally based and understand the nuances and how to make these smaller size deals happen, that it's going to fill that gap in the market that I think we really need to grow this early stage VC market.
Samuel, can I jump in there?
Okay.
Samuel, can I jump in?
Sure, go ahead.
Yeah, so sorry, I mean, obviously, Robert's sort of front running this, but this is precisely what Renew is established to do. So, you know, for 9 years in Ethiopia, a couple of years in Uganda, and just starting in Rwanda, we are, you know, our objective is to fill that missing middle, both with access to finance and access to operating expertise, which allows businesses to go from that sort of $100,000, $200,000 turnover up to the sort of 2 to 4 million level. And our job essentially is to take those guys and to turn them into $2 million EBITDA companies, so that the IFC, CDCs, DFCs, and the bigger private equity funds who have minimum ticket sizes of 7.5 to 5 million have something to look at. At the same time, when the VCs come and say, "How am I going to exit this?" To hit my IRR, we are the solution to that as well, and which is why we think we have an opportunity with the support in a blended finance model, which is different from other blended finance models, to address that missing middle, the link between the early stage and the later stage.
Absolutely. You know, that's something, Paul, that we have also been looking at within the entrepreneurship fund is really trying to create that secondary market, and also that cliff which they fall off from the incubation stage, where you have abundance of liquidity in terms of grant money that's around now, but you know, the idea of the actual value creation to create interest from the larger ticket size GPs that come in. So having said that, that's a perfect segue to our my next question, which is, how important is TA and grant money within the ecosystem of startups and early ventures, along with how do we transition from that grant money to in terms of the value creation process? We've seen this is more in Ethiopia and a few other countries now that there is such an influx of free money that is put in through grants and early stage acceleration and incubation. But then following that, it's the big neon, it's the big gap where essentially what we just spoke about in terms of the missing link. But again, how can we balance that? Again, this falls into the blended finance type scenario also. But where do we put the weighting on TA versus risk capital within the ventures? Samuel, do you want to start on that?
Okay, Samson, yes. I mean, this is an area that I'm very passionate about because that's what I've been doing for a lot of my life in IFC. So the thing to do is to blend technical assistance and grants with commercial capital. I mean, players would not be doing a favor to the startups and entrepreneurs by showering grants on them from day one and expecting that the next day they'll be able to take 100% commercial capital. So for us, the key thing for us is that you should be on a role of your own for technical assistance to come and help you improve either your operational stuff or other things that you need to do. Now, yes, there are times when $100,000 commercial capital does need to be blended with, say, 50,000 grant money or soft money to then make an expansion opportunity more viable, because in some high interest rate markets, commercial capital alone will be too crippling for a business that is beginning to grow. So that is when, of course, you can bring in grant money or technical assistance money and say, if you're able to get yourself $100,000 of commercial capital, you will then qualify to get this additional capital, and I'm going to call it capital, not a grant, on soft terms, for you to then be able to overcome the hurdle that we can see that you've displayed in your projections on how your business is going to grow. And then the other part is that money, capital is a key thing, but it's always not the only thing, right? So fund managers and the investing community has to find out how the operational expertise is going to come. How is the business going to grow from where they are to another level? If the current sponsor has done the best that they can do at that level, how do you help them to identify expertise that can help them move to better margins, move to larger volumes, get to be able to then operate at a larger scale at different levels of operation? So that for me is key where it is. Technical assistance has to move towards blended finance and value creation for the companies so that the companies then are able to progress on their pathway. Otherwise, it's a never ending cycle of this grant came available and then it disappeared and then the companies died and nothing really happens. So I'll stop there.
Great. Robert, do you want to?
Yeah, I mean, I think you kind of summed it up well, but maybe just to add, I think, and to pick up on your point, Samson, it's, I think there was a need for, let's say, more grant and base capital to spur entrepreneurship and really, let's say, get the early stages of the market going. But yeah, I would argue that in a lot of markets now, we see too much of that and it's distorting investment, right? So I think the donor community writ large needs to continue to evolve how it's applying that. And I, might be a little biased, but I would say the DFIs are perhaps, at the head of that curve. So, but we also need, some more of the more traditional donor elements and philanthropic elements to really continue to think about how you're using that grant capital, and just like Samuel said, in a more blended finance approach. And I think there's so much room for continued evolution around the blended finance mechanisms, right? I mean, because I guess one could argue the combinations or the models of those are endless, but I think it's also about educating, you know, capital providers on those options around safe notes, but also helping to educate the entrepreneurial community even on kind of the basic terms of these different kinds of deals and how capital can be used in various ways. So I think we have a long way to go in this kind of blended finance world, which is, you know, exciting because I think that's what's going to take our new mechanisms and new approaches to help continue growth in some of the kind of more middle tier markets.
Absolutely. I mean, it's going to be a calibration of different types of blended financing over time. Marco or Paul, do you guys want to, do you have anything to say on this?
Sure. I mean, I think certainly at this very early stage, I really have no problem with TA and donor money. In developed economies, taxpayers understand. In the UK, for example, we use the Green Book. Creating a job has cash value, and the government will give that cash value to the business or to the investor in that business. So there's clearly a need. The cost of investment, the cost of due diligence. I mean, unless you take a different sort of view and systematize the approach to sort of the risk-adjusted return calculations that you make, there's still a lot of work involved in these transactions, even documentation. So to expect early stage very early stage entrepreneurs or very early stage businesses to be able to stand on their own 2 feet anywhere or almost anywhere on the planet, frankly, it stretches me. I'm a very optimistic person, but that stretches me. Then, however, I think the interventions that the donor community can make, I think it's been alluded to a couple of times, Samson in particular, there is a bit of crowding out going on. There is a bit of duplication of effort. There is a bit of an issue created by the well-meaning attention. And I think the kind of interventions that donors can make at that level, rather than sort of calling it sort of pure technical assistance, and that is needed as you come up into the sort of the missing middle, let's say. Access to finance, access to people, those are the issues. So, I mean, if I was a donor, I would be saying, how can I use my capital to mobilize more capital? How can I combine with other philanthropic organizations, aid organizations, DFIs, and commercial capital to leverage the sort of the lowest, the most risky money 100 times or 50 times or whatever it ends up being, depending on the jurisdiction and the structure that you use. And so, creating an organization or a bank that's sort of directly sort of focused on early stage businesses and taking off the risk, but not the moral hazard, is probably the kind of intervention that I think would be more commercial and sustainable in the long term. And then taking it a bit further, and where we are, for example, we have an investment business. And we invest in small companies. They're not the smallest companies, but they're reasonably small, and they're stuck in the missing middle. The cost of investment is the same for those deals as larger deals. So between $100,000, $250,000 per transaction all in. It's a lot of money if you're trying to do a $250,000 transaction. And generally on the planet, people don't like investing in SMEs because they're relatively expensive to invest in, and there's still a lot of risk embedded in the equity story. So how do you reduce that cost and risk in a way that's actually sustainable and supports mobilization of even more capital? And that's kind of the model that we run. So we have a business called The Exchange, which is the second leg of the firm, which is targeting specific capacity building initiatives in the geographies that we operate, building human capacity, ecosystem capacity, policy development, investment environment, advocacy, all these sorts of things, regulatory reform and change. And we are very lucky because we have long-term multi-country relationships with donors who see the impact value of simply building capacity and developing ecosystems. And so do we. So full stop, we think it's a great thing. But for us, from my investment practice perspective, that training, capacity development, ecosystem development activity not only creates capacity and generally benefits the private sector as a whole, but it also creates a pipeline of increasingly investment-ready businesses. So the donor support that goes into the training is entirely sort of separate in the end from the commercial capital that goes into the investment, but obviously the risk-adjusted return expectation on the investments themselves then start to make more sense. So that's the kind of model that has been developed and which we see already working reasonably well. And then again, back to the point that Samson made, the access to finance is one thing, access to human capital is the other. So how do you find a world-class operations manager? How do you find a world-class CFO who's going to sort of see the CEO's vision and say, listen, boss, this is how we go from A to Z. This is how we create the scalable platform that we can then scale across 15 countries on the continent. Where do you find those people? Because although they're amazing, intelligent, innovative people on the continent, there's not a lot of people with 30 years of experience of doing that. And if you find them, they're going to be expensive. So that's the challenge. And that's also something that we solve because the donor finance that we use to deliver capacity development and ecosystem development is leveraging the same people who work in our investment business and who go and live in our investee companies and create the world-class platforms to allow scale so that we can get to 2 million EBITDA and into the private equity threshold as quickly as possible. So I think there's a lot of, as Robert said, there's a lot of innovation to come. But I think moving away from the old-fashioned approach is certainly something that we would welcome.
Excellent. I think we all share pretty much the same opinion there in terms of the de-risking capacity of TA from different perspectives, whether it's technical, human capital, and so forth. And again, that is also the focus of the Entrepreneurship Fund in terms of really trying to calibrate the equity and risk capital along with the TA as well as other forms of financing. Marco, any thoughts on that, or shall we move on to the next one?
I think from the NFS perspective, I think we have observed a increasingly innovative kind of TA, right, being commissioned and implemented, and we certainly welcome. For example, we have had several mandates to help early stage companies in Africa to become investment ready, so somehow to accompany them on an equity raise or on a bond arrangership. So kind of a less traditional type of TA, and not just business advisory, but specifically focused on capital markets. We certainly welcome the development, and I thought it's interesting compared to the past. And it kind of echoes also, I think, in the KfW, in the African Local Currency Bond Fund, right? I think they had a special pocket, specifically to deal with all the complexities of tapping capital markets. Of course, that fund is not necessarily for startups or early stage, but also for kind of growth enterprise. Anyway, so I think we've observed the greater innovation in PA, and that's my cat.
That's excellent.
Can I pick up on that?
He always comes when I speak too much.
Well, I want to add to what you said to also talk about another area we're focused on. I mentioned it's around this life cycle support that that we've been calling it, but it is just what you said, and perhaps the same approach that you're taking. It's about how are you providing that investment readiness as TA support, or even transaction readiness TA support, right? So it's about how is the donor community providing that support, but through more of an investment lens. Because I think that's kind of one of the problems we've seen is there's a lot of that out there, but there's still this disconnect with what investors need. And so how do you build that linkage better in providing that TA? And that's, again, you're starting to see a lot of models pop up that are thinking holistically or across that life cycle from very early stages through acceleration, perhaps even investing, but then linking with the follow investment that's needed. And so it's really taking that holistic or life cycles approach that I think we need more of.
Absolutely, fully agree.
Yeah, great. At the next point, we have sort of touched on it already, with regards to the linkages between the early and more developed ventures. But, you know, it's just the thoughts of where we are in terms of creating a secondary VC market on the continent, because essentially that would be providing additional liquidity to investors, right? And this would be even more interesting in countries like Ethiopia, where there are capital controls. So we'll come to Ethiopia next. But generally speaking, you know, there's a couple of VCs out there which are trying to, with different degrees of success in terms of creating a secondary VC market where early investors can offload to some later stage investors and create, you know, a liquidity and sustainability of the investment across many years. So just any thoughts on that? I don't know who wants to start on this one. Robert?
Yeah, I mean, I think there's definitely a need, like we said earlier, I mean, in terms of what are the ways you need to provide exits, and there's a variety of ways to do that. And I think it does come down to local conditions. So looking at countries and the regulatory environment there to understand and try new things, because I think you're also seeing people kind of address it at local level, and I think we need more support. So yeah, I mean, I just kind of agree that that is definitely a need, and it really comes down to kind of a national level approach, which, you know, I'll defer to people that are perhaps more steeped in Ethiopia to tell us perhaps what should happen there.
And absolutely, I mean, we'll move to Ethiopia. This was more on a continent level. I think Samuel wanted to say something.
Yeah, Robert, I mean, you're right. There's a whole environment issue, but there's also the market has to kind of give birth to itself, if I'm saying the right thing, right? The deals that fund managers are able to put on a secondary market will kind of create that market, I think, because we're not seeing enough good exits from fund managers and PE funds on the fund. There's not a vibrant market in terms of deals moving from one to the other. And so the secondary market will hopefully be a natural evolution when you have that level of activity going on in different countries and looking for deals in East Africa, and the fund manager looking to pick up a secondary because he's exited something in AgTech and wants to continue on it and build on it and so on. So I think there's the regulatory part, but there's also the deal part as well, which has to grow, has to become more flourishing for the thing to embryonically grow, and then demand for the right regulation will kind of follow that or be alongside that. Yeah.
I mean, it becomes, you know, there's more emphasis on it simply because of the lack of capital markets in most of these countries, right? So, Mark or Paul, anything on this before we start to
I mean, I was just going to say
on the Ethiopia?
Sure, I was just going to say, I mean, we do need to work on it ourselves, right? And you can explain to governments and enablers about the sort of longer term benefits of creating liquidity in their jurisdiction or across the region or continent. But there have been sort of increasingly impressive, I wouldn't say absolutely impressive, but increasingly impressive efforts to create sort of deal dating platforms for those who are interested in this asset class, whichever one it is, but let's say East Africa SMEs, for example. And I think there's quite a high risk that some of these platforms, given the technology that they're using, might turn into sort of exchanges, I mean, like almost formal exchanges of their own, right? So in the old days, it would really just be about trying to match, in an analog sense, investors with entrepreneurs, and then they take the whole dance offline. But these days, a lot of it can be left online, and in particular, it can sort of streamline processes, and if nothing else, just make more visible the opportunities, across a region or in a country or in a sector, however you want to cut it up, it's obviously so easy to do now. And that in itself, just that visibility draws more attention to the asset class. And as the sophistication of the sort of onboarding process increases, both technologically on the platform itself, and then in the jurisdictions where those deals are coming from, then it all starts to speed up, and it's I think it's reasonably a reasonably virtuous circle. And then for me, the really interesting thing about these, and in terms of exit, because I guess we probably all of us spend probably 25% of our time thinking about exit, or at least sort of monetizing the value. And you can clearly see with some of these platforms that if they take off and if we all support them, then it will be actually quite easy to monetize, unitize, or digitize our interests either in individual transactions or companies or in funds. And then our ability to sell sort of infinitely small fractions of exposure to those who are interested in them becomes that much easier. And if the enabling environment and the compliance environment is then sort of aimed at the level required from the source of the capital, then it starts to move, and it might actually sidestep the local capital market or secondary market itself.
Great. Marco, anything on that before?
Yeah, I mean, I think as the primary market volume continues to increase, I think that there's a strong case, right, for this kind of secondary market developments, and I think that really can be a game changer. There's certainly been a lot happening outside of Africa in that domain, so fingers crossed. Yeah, it would certainly be a welcome development, I would say.
Great, Marco, thank you. So let us transition towards, again, we can make reference to the region or the continent where it applies, but moving on to some specifics on Ethiopia and the surrounding region. And one thing we had done at SWAY in collaboration with the Jobs Creation Commission Ministries is really do a market mapping of the different startups and high growth digital companies in Ethiopia. I think what we've done probably haven't done before, over 200 plus companies, which we were able to drill down and look at their needs, where they are, and what sort of technical and investment needs that they have as part of our work for the Entrepreneurship Fund. Having said that, one thing that obviously stands out clearly is, the lack of deal flows, especially when it comes to earlier ventures. We do have two PEs, as Samuel said, which IFC has invested in, also Zocalis and the Cepheus, and we also have Renew, which probably acts at companies that are slightly smaller than what Cepheus and Zocalis, correct me, Paul, if I'm wrong, that are slightly smaller. But and I think probably Renew is probably in one or two angel networks are really the ones that are starting to focus on this missing gap, and that's where this Entrepreneurship Fund also really wants to focus. I think there's more than enough space for quite a few players to come in and even collaborate on this. But having said that, again, very few deal flows, hardly any acquisitions when it comes to startups or these high growth digital companies. Again, we've seen it in the fast consumer moving businesses that there have been quite a few deals. But why? I mean, most of the questions or answers are already there, but it'd be good to highlight them again. I guess I'll let Paul start with this, because you're probably in the same boat as us. in terms of, and then Marco also has done some significant study, and then we'll go through the group.
Is that an Ethiopia question or a
Yeah,
yeah.
Ethiopia.
Yeah. So and I think I mean Ethiopia is unique in so many wonderful ways, and it's also reasonably unusual in the extent and sort of depth of the challenges that entrepreneurs face. And I think there's really sort of two basic reasons for it. One is it's an incredibly young market, right? The private sector didn't exist at any real scale until a few years ago. And so the practice of operating in the private sector is a rapidly developing game. Whether that's from the entrepreneur side or whether it's from the government side. And I think the other sort of point I would still sort of quite reluctantly make is it's not immediately clear to me how aligned policymakers are on promotion of the private sector. And I don't think it's sort of because they're not, it's just they're not aligned. And there are a number of challenges to doing business in Ethiopia, which means that you run into the regulatory environments all day, every day. And I think, so starting a business is hard, building a business is hard, continuing to trade over time is hard. There are a number of regulatory issues. And it's interesting when you sort of just compare Ethiopia to our nearest neighbors and the sheer excitement around private sector in those countries, up and down, left and right. It's tangible. Major Japanese retailers opening in Kampala, first big sub-Saharan opening. It's clear that the private sector is vibrant and it's supported and all that kind of stuff. I think it's just not quite yet the case in Ethiopia, but I think everyone is learning as they go, and we're making progress sort of day by day, month by month. And there are a number of macroeconomic reforms. There are a number of sector-specific initiatives. There are a number of other sort of regulatory changes being made, all of which sort of over time will make it easier, and therefore easier to start a business, easier to build a business, and deal flow then increases. But the other aspect in terms of just general M&A activity, I mean, there really isn't domestic M&A activity in Ethiopia. I mean, we could probably come up with, on one hand, the number of sort of genuine domestic M&A deals that have been since I've been here since 2016. All of the deals that happen are FDI. And so you ask yourself, why is that the case? And ultimately, the incentives for that kind of activity just are not there.
Except for the fast consumer goods, right? I mean,
well, sure. I mean,
in activity, you'll see
in the domestic
those.
market. Yeah.
Okay, great. I mean, I fully agree. I mean, as you said, there's many initiatives coming up: the Startup Act and the digital strategy and the facilitation of opening businesses, and hopefully also, one obstacle is obviously the floor in terms of how much foreigners can invest, or a foreign entity can invest in Ethiopia, which constrains VCs or early stage investors. And obviously there's some ways in which we have looked at and are trying to apply for the entrepreneurship fund with the help of the authorities. But yes, I mean, there's many, and obviously the most obvious one is capital constraints, right? In terms of FX and the depreciation of it, along with it, does not help. Great. Anything, having said that, again, I think we are working through a lot of those issues. We've done a lot of work with LFS Advisory, Marco and his team, in terms of structuring this fund in such a way that we can address some of these smaller companies and the linkages that needs to be done between early stage and the more developed GP investors. Any comments, Samuel or Robert? Doesn't have to necessarily pertain to Ethiopia. I mean, some of these issues are relevant across the board.
So just to say that I think you mentioned it, but we've seen efforts by the government of Ethiopia to improve the situation. We had the investment proclamation come out last year, and this year there's also a draft on startups and innovation support in the country. So those are, I think, steps that suggest that the government is looking to find ways in which the private sector can participate better, whether foreign or local. And DFIs like IFC, of course, with the World Bank Group, will be there to work with the government to the extent that it's possible to improve this. At the same time, I mean, we will continue to support investments both at the VC startup stage and at the PE stage, like we've done with say, Restraints and Scales. There's definitely room for different types of investment vehicles in the country. And so our products as well will continue to evolve to be able to support that. Of course, direct deals will continue to happen, but we see hope. I think we see that the demographics of Ethiopia are huge. I mean, the second most populous nation in Africa. You've mentioned that it's a very young population, so we
70% below 25, right, or 30 years old. So yeah, definitely.
Sure. So very soon they will all want a set of trainers and stuff like that. So definitely, I think we're going to see different things happen, and we'll continue to be in the market to support. Thanks.
Excellent. Robert or Marco, anything on that before we move on?
Yeah, I mean, I'll just say a general need, and perhaps taking a slightly different direction, something that might be a little early for Ethiopia, but generally speaking, corporate venture capital, I think, is something we need to see much more to help accelerate the VC industry, let's say. And I think that is still very early stage in a lot of countries on the continent, but a big area for growth. And so how do governments also incentivize that too? So it's keeping that as part of this equation, and really thinking about then how do more typical VC investors also support what corporates are doing in this space, I think is another area we could help along a bit faster.
Marco?
I was just thinking the telecom liberalization in Ethiopia. I think that's a big development, together, of course, with the regulatory, the investment proclamation, also as mentioned by Samuel. Yeah, I mean, it feels like, I think penetration is still quite low, right? So certainly it's
low, but the numbers are still high, even though the percentage is low.
Right, of course, on 112 million people, it's
yeah.
It's a lot of phones, but yeah, no, definitely, I think very
and I think
exciting environment. Yeah.
Go ahead. I think one thing we need to realize is, Ethiopia as an economy, I mean, there's regional players, but Ethiopia by itself is probably encompasses 3 or 4 of its neighboring countries in terms of actual economy and population and activities. So definitely a large playground to play with as things come to bear fruit. I just want to quickly say to the participants, feel free to post your questions, and we will be happy to provide them to the different panelists that we have, and we'll leave some time for that at the end. Just quickly moving on, in terms of Ethiopia again, but again, this can be relevant to any nascent market where early stage investment is not mature, is how do we standardize and implement valuation? I mean, a lot of these companies in Ethiopia, are pre-seed or pre-investment. So and are functioning on grants of, you know, a fixed amount. And also there's regulations in Ethiopia where, you know, but we'll leave that on the side in terms of looking at just fixed assets and so forth. But you know, what experience do you have? I know Renew has done a couple of investments. Here, the latest one in food delivery, I think. Delivery Addis, delivery or delivery Addis, one way or the other.
Deliver Addis.
Yeah. Again, right? And that for me is something I guess myself and LFS, also Marco, we looked at while we're doing our work for the last 6 months on this, in terms of coming up with you know, the actual, and the other thing is actually teaching or you know, having that the actual owners of the ventures need to have some understanding also of the value of their business, right? And I think that part is really comes from the TA side also, amongst many other things. Just you know, your thoughts on that topic in terms of how we standardize this, or obviously with the proliferation of deals, this you know, some sort of standardization or comparison can come into play. But with Ethiopia, especially with all its idiosyncrasies, it's very tough to look at comparison multiples or anything like that, right? So it'd be interesting to see what your thoughts are. Some, I guess, are practical in the case of Renew for a couple of investments, and in other cases, maybe what you've seen in other countries, or from a theoretical perspective, what you'd expect.
So for me,
Who wants to take that first?
sure. Yeah. So from Renew's perspective, we've done 15 investments. I think we are technically the most active investor in Ethiopia when it comes to SMEs, at least, but probably more widely. Yeah. So I think you know, when we think about the pipeline, it's really about investment readiness. You know, the entrepreneur's sort of understanding of the way the private equity operates generally, how he understands the value of his business, and that's why we spend so much time training and coaching way down the pipe, so that hopefully by the time people's businesses are, you know, they have revenue and are making profits, they've been operating reasonably sensibly for a year or so. If they've received sufficient training, you know, for example, from the Renew programs, then they'll sort of understand better how to sort of prepare themselves for not just the sort of value discussion, but also the structure and terms and conditions sort of discussion. So obviously, when someone's selling a business, they'll use the comps if that makes most sense. They use a DCF or the asset base if that makes most sense, and that's the opening point. You know, no one has a monopoly on the truth, but never let the truth get in the way of a good story, all that kind of stuff. I mean, clearly in Ethiopia there are sort of specific sort of, I guess, historic issues. The whole ecosystem is not familiar with earnings before interest, tax, depreciation, amortization. It doesn't know how many deals were done at 5 times or 10 times. You know, these sorts of things just are not sort of day-to-day conversation that they may well be in other money centers or capital cities. You know, the guys with businesses that are valuable in a sort of asset or EBITDA sense typically have been running them for 20 years. They're family businesses. Now they have a very fixed view on what it takes to get them out, if ever. And so it's a very sort of intuitive. You need to be intuitive about it. You need.
It's probably never on that one, right?
Yeah, exactly. But you need some, you know, Ethiopian emotional intelligence to start the conversation. And obviously, as you know, many people know, there's a whole sort of issue of pride with respect to the value of my business and my family's investment in it. And you just have to be sort of super careful when you're starting to engage. So we do a lot of education at the, you know, hopefully before they come to us. We and others hopefully are helping them to understand better what the sort of the private sector generally looks for, both in Ethiopia and particularly elsewhere. Whether they buy it or not, I guess, is up to them. But if they don't buy it, the chances are they're not going to be good investee companies for us. They need to understand the context in which we start that discussion. But we're more than happy to spend a lot of time, because it's funded by donors, educating them on that sort of process. Practically, actually, we don't spend a lot of time in the sort of pre-money or sort of pre-profit stage, to be honest. We will look at them from time to time. But even when people are profitable and have been for a couple of years or 3 or even 10 years, there's often a big gap between what we see as the value and what they see value as in many places. And we can discuss how that comes about generally, and also in Ethiopia. But from a practical sense, what we say where that's the case is we don't need to value your business now. We just need to know that when the business is valued in future, we'll have our share and we'll make an appropriate return. So that's kind of how we often sort of go through. If we can't come to a landing on today's valuation, we say flag it. Let's come back to it when somebody else has a view. And so by definition, when you have 2 or 3 bids in 2, 3, 5, 10 years time, that is the value. Of course, that's it's cheating a little bit, but it just avoids confrontation at the front end. And what we want to do is get the money deployed. We want to get the businesses on a strong fundamental platform so they can then start to scale. And so it makes it harder, but it's just the way we do it.
Fully agree, Paul. There needs to be quite a bit of flexibility in terms of our approach, in terms of valuing these.
And of course, and as you know, in Ethiopia, you can't just say, I agree that $1 million is 51% of your company. Even if you and I agree that, we can't transact it because we can only, without friction, we can only buy shares at par. Otherwise, it creates a lot of aggravation around the place.
Absolutely.
And then, of course, when people are investing, generally, I think most people will try and have an offshore holding company investing into the onshore holding company. And where we're allowed to invest because the sector is open, we want to control the business from the offshore company rather than in the offshore company. So that's another layer of complexity from a structuring perspective. But we find that actually quite useful because it's actually a perfectly legal way of creating offshore wealth when the entrepreneur participates in the value creation at an offshore level. And there aren't many other legal ways of that happening.
Well, I mean, it's great until you can expatriate the money, right?
Sure, back to FAs. But you don't need to sell, you don't need to repatriate the money, you don't need to sell the onshore shares, right? You sell the offshore vehicle because someone has a view. Yeah. But it does reduce the market a little bit at that point.
Yeah. Samuel, Robert, any thoughts? And it doesn't have to be specific to necessarily Ethiopia, but I think.
Yeah, well, I'll jump in because I'm just thinking more broadly. I mean, this is a difficult topic across any nascent VC environment, right? So I think the approach that Paul was talking about, Reno's approach, is spot on. I mean, there's no one way to do it. I mean, maybe to add to say, I think what we also need, is frankly more of an approach like Reno in more markets, right? It's this accelerator or business development support community or these intermediaries or entrepreneur support organizations, whatever you want to call these providers, but we need those, I think, to better understand and support businesses in a way about not only just becoming investment ready, but transaction ready. And it's bringing that understanding of also how to help people understand valuation, because it really takes a strong baseline of financial understanding and skills that's just not out there. And so I think let's also, as donors and as TA providers, help this intermediary crowd be bringing that lens and providing that services and assisting ventures better, because it's just not an easy thing to address.
Absolutely. I mean, I think that's one thing that TA needs to really focus on also. Samuel, you have additional comments?
So yeah, just to add that from our SME ventures perspective, we do a little bit of capacity building for fund managers. We have a whole package of what we call GP institutionalization, and mind you, all of this is in our SME venture space, and we don't do this for bigger funds, but we agree that there are some things that we can help them move along to, and of course using whether it's an international IPEV guidelines or whatever, it's something that we draw our fund managers towards, and we require that they use them. And we continuously support them to do that. Most of them are able to do it, don't have much of a choice, if I can put it that way, but we make sure that we're gradually moving them in that direction. But I think Paul's approach is basically spot on. It's what the market is gonna pay. So, you know, you even though you have to have some kind of entry multiple and stuff like that, I think his approach of engaging with them and agreeing something that can move them forward makes a lot of sense in the markets that we operate in. Yeah.
Yeah, it's more of a relational approach than a market multiple or other technical approach. Marco, any additional points?
No, I'd say nothing.
Okay, great. Let's see how much time. Okay, we don't have much time, so let me see if there's any pending. I think I had sent you guys all any.
There's a question for you.
Yeah, I saw it. We'll get to it. But I wanted to finish up some of the other key questions that we have here to really drive the next high return companies. We need smart investments. Okay, I think we've pretty much answered most of the questions. Just a general question in terms of, and again, I think we've answered this from both a regulatory perspective and Paul, I think clearly elaborated on valuations and TA and so forth for the country. But again, it's how do we attract, you know, most investors that we have are FDIs, right? Or other institutions related to DFIs and so forth. How do we attract private capital, right? In terms of looking at Ethiopia as really a place where you know, we can generate returns and you know, go beyond just the you know, the IFCs or the FMOs of the world, in terms of attracting some of those, you know, private capital out there. And obviously, you know, the DFIs are there in terms of developing that market as early entrants. But again, general question, but any thoughts on that before we answer the last few questions from the participants?
So I'll take a stab at that quickly. I think the role of FDIs is really to demonstrate that there are viable investment opportunities in these markets. So a lot of what we did in the 2000s, 2010 was really to demonstrate that private equity as a vehicle worked in emerging markets, and particularly in Africa, in some of the most difficult countries. I think FMO and ourselves, we were in the Democratic Republic of Congo in 2010, investing in a fund, which has turned out to be quite a good fund, and is now on their
2010. Wow.
Yes. It was that interesting. So I think our role is to demonstrate that this is viable. We don't intend to be. We hope not to be in, you know, the fifth or so fund of CFOs and Zascalis. By then, other capital will then be able to come in and see the track record of CFOs and Zascalis and say, yes, this is a good deal. We're going to come in and invest in you as you go into your fifth fund or your sixth fund. So that is really the way we want to open up the market. Of course, looking at regulations, demonstrating that capital works, taking the initial shocks if we have to. But then by the time these fund managers and get to their fourth or fifth fund, we're gently nudging them and say, look, go find private capital, make the market more interesting for others. I'll stop there.
Excellent. Robert or Marco, then I'll come to Paul, who probably has direct experience in terms of attracting, you know, we're going through the same path also, but let me go through Robert and Marco, and then we can finish up with Paul.
I'll jump in to say, I mean, absolutely agree with Samuel, as kind of the DFI community can help in catalyzing that and paving the way and showing that these deals are viable in these challenging markets. And I guess along with that, and something we're looking at within this ecosystem work, is how are you also sharing that information more broadly to communicate and signal to interested investors that these deals are happening and they're viable. And so, you know, we're looking at that, perhaps looking at supporting platforms that are doing just that, to really communicate these deals and show people and get people interested in the market in Africa, and that there's potential investments to be made.
Great. Marco, anything, and then we'll finish up with Paul on this, and then we can go to some of the questions that the participants have.
I think that there's a role for all of us, yeah, to facilitate that, and certainly DFIs, commercial investors, and I think, yeah, I mean, I also very much believe in the impact that the fund we've been working on can hopefully have, yeah, some patient capital equity fund. I think from what we've looked at, certainly I think has the impact to catalyze. So yeah, let's hope. Fingers crossed.
Paul, do you want to finish this one off, and then we'll go to the questions?
Sure. And so on an Ethiopia-specific basis, the number one issue for discretionary private capital is the foreign exchange regime, right? Mm-hmm. So if you put money into a country, you need to have a reasonable expectation of it coming out when you have the means and the resources to do that. And that's simply not the case in Ethiopia currently. However, there's a whole bunch of mandated private sector capital, and we consider ourselves mandated because we're passionately committed to supporting the development of Ethiopia as individuals. But there are things you can then do to make it sort of a little bit more feasible. And people like the IFC are doing great work in trying to convince the government to create mechanisms by which foreign exchange can be more visibly repatriated, to have less uncertainty around an individual company's ability to use its own foreign currency, for example. But fundamentally, you just need to find businesses that generate foreign exchange in Ethiopia. So one of the reasons there's not a huge amount of M&A is that actually the whole country is managing FX. People aren't managing businesses, they're managing foreign exchange. So where you do have access to foreign exchange. Yeah, so where you do have foreign exchange, you don't use it to invest in a sort of 7 to 15 year business case, creating prosperity for as many women and youth as possible. You use it to import what you can and make a 100 to 400% margin depending on the product. It just creates the wrong kind of incentives right across the economy, literally from top to bottom, left to right. But within the private sector, there are people who are focused on the longer term, and I'm not saying the government's not, but there are people focused on the longer term, and the business case just needs to be self-sufficient for foreign exchange, initially for working capital OPEX, and ultimately for servicing offshore capital. But I think the work that the DFIs and the donor community are doing just to make it visible is extremely helpful, maybe not in the way that was originally intended, but fundamentally the government has to make a decision that it's committed to promoting the private sector and then to act accordingly. It's not easy. The space is tricky. It's a febrile political environment. Not everybody agrees. Amazingly, we haven't talked about the banking sector yet, and the fact that is just fundamentally not fit for purpose when it comes to supporting the growth of the private sector. But there are a lot of people who don't believe that the private sector is a good thing. There are a lot of people who believe that there should be no foreign banks in Ethiopia, for example. So that's leadership, that alignment, I think is it'll be the single most successful thing that happens as soon as the government is prepared actually to both say it and do it.
Great. So I think, Paul, I think a lot of us agree with your last few points in terms of key developments that are needed in the country, and FX being obviously a key proponent in terms of both the expatriation and especially in the last year or so, the acceleration and the devaluation of the FX, right? So, and we actually went out and checked if we could hedge it with non-deliverable forwards, but the interest rate differentials means that you're probably better off taking it's cheaper taking the FX devaluation risk than
Just where the risk.
than actually trying to use.
But in fairness, I mean, in fairness to Samuel and others, and looking at the telecoms deal that was mentioned earlier, I mean, there are people working to create visibility around it, right? So the IFC has a program. We have yet to see a project, but there's a program where there is the opportunity to negotiate some kind of visibility in future, and slowly. Yeah.
Sorry, guys. So, just quickly to answer some of the questions. If we go some of the straightforward ones, why are the majority of startups fail after incubation? I think we sort of mentioned that part. You know, there's definitely a missing link there in terms of the abundance of free money also early on, and really no structure, both TA and risk capital that comes on after the incubation or acceleration phase. And I do believe that you know, the entrepreneurship fund that we're doing in Renew and a couple of other angel networks that are in place are really trying to plug this hole. In terms of the entrepreneurship fund and what we're looking for with regards to investments, you know, we're looking at, you know, 4 or 5 key criterias. One would be, you know, in terms of the idea, the feasibility, scalability, uniqueness, and the opportunity of the actual idea. With regards to the business, of course, the core team is key. You invest in people as well as the business and the business model, the revenue model, and the pricing and costs within the sector that they're in is key in terms of the future, the strategic plan, the usage of the funds that we give, the actual value add, and in Ethiopia, even though this is the toughest part, is the actual exit strategy, and all of that, of course, comes with the ROI. So hopefully that gives you a quick overview of how we would look at in terms of selecting startups. And of course, the startups we select would be across the investment value chain. So we are more than open in terms of looking at you know, high digital growth companies. And in fact, we've sort of split it into 3 tiers with some of the mature digital companies, which are high growth, also within the at least the pipeline that we're looking at. 2 other questions that we have: what can you advise for funding for an idea stage startup? I guess there's abundance of, we've spoken about that free capital. You can knock at MasterCard Foundation's door or multiple other startup doors, usually funded by MasterCard. In terms of looking at that, I don't know if you guys have any other suggestions. The next one's, can you advise me on how to proceed to secure pre-seed capital? I would personally come up with the same answers I did just before. If any of you have any additional comments for the first 2 questions, Paul, go ahead.
Yeah, so there's Addis Angels operating you know, primarily in the capital, reasonably.
Not the idea stage, I don't think, right?
Yeah. And I know. I think it's just a question of how you present it, right? And then the other one is Chiggin, which Renew operates. So our sort of early stage, so ideation to incubation intervention is called Chiggin, which is essentially a sort of Shark Tank for people at the very early stage.
Yeah, perfect. I think you have a TV show on that, or you're going to have a TV show on it, right?
We do. Yeah, absolutely.
I spoke to your partner on it. I had actually
Laura.
come over. Laura, a few months back. Great. And then anything else? I mean, I guess the first two questions asked by Michael were pretty much answered. I mean, I think we have more than enough incubation acceleration hubs between the X Hub, the ICE Addis's, and the Orbit Health and so forth across the nation. Great. We have sort of gone past the time that we had allotted for this. I just wanted to thank you all, primarily the participants in the panel. Thank you for your time and for agreeing to be part of the conversation, and to the participants for staying the course, and hopefully you found this interesting. Thank you. Thank you, everybody.
Thank you.
Thank you, Samson. See you soon.
Thank you. Thank you.
Thank you, everyone.
Thank you, guys. Take care.
Okay.
Bye.
Bye-bye.
Is the movement of Ethiopian entrepreneurs and innovators. A network of daring entrepreneurs transforming the way we live.